Hello and welcome back to Crypto Saver. So this is part 2 to our series of where we are developing a delta neutral strategy within the Taro ecosystem using two projects in particular, one being Anchor and the other one being Mirror. Now, if you haven't seen part 1 yet, make sure to check the description below. I have it down there and I do suggest watching it, otherwise you're going to be lost. And as a quick recap, in our first video, we took $8,000. We transferred $8,000 from the Ethereum network over to the Terra network. We then took a portion of that money, deposited it into Anchor, and we were able to use the funds within Anchor to then short a few synthetic assets within Mirror. And we had to wait about 2 weeks. So again, if you haven't seen that yet, check out part 1. But in today's video, we're going to be hopping back into Mirror, and we're going to be going long on these synthetic assets because that's the last and it's the most important part of this delta neutral strategy. So if you're ready, let's get going. Okay, so as a quick refresher, what did we do in the first tutorial? We came on Mirror and we decided that we wanted to short two stocks, in particular ARK and Twitter. So here are the two positions, right? You can see under the borrowing section, we have our ARK position, our Twitter position, how much we borrowed and sold into the market right away. And more importantly, if we go towards the bottom, which shows our short positions, because again, we borrow from the top, we short down here, you can see how we have the UST available from shorting the stock. Now, this is typically available 2 weeks after you short a stock. I have been dragging my feet in making this video, so more than 2 weeks has passed, but here we are, so let's get started. In a few minutes now, we are going to come and hit on claim UST to take this UST and simply complete the other side of the trade, which would be going long. And in doing so, we will now be delta neutral. I mentioned in the first tutorial that I have done this on two previous positions, Tesla as well as, I believe, on Netflix. Yes, so if you look here, this is our liquidity pool on the long side, right? LP, liquidity pool. So we have Netflix here, we have Tesla here. Silver is only partially hedged. I didn't have the full UST available at that time to perfectly hedge it, delta-wise in that exact moment. And the only position I hold, disregarding Twitter and ARK, since we'll get to that soon, would be Amazon. I have not decided to go long on Amazon. It currently sits as only as a short position. Fortunately, Amazon has traded lower since I've shorted the stock, so it has benefited me for the time being. But since it is one of the largest stocks available to trade on Mirror, the movements are quite slow, and I'm not too worried about accumulating too many losses on it in the meantime. So let's head back to our handy little slideshow here. You might recognize this from the last video, but I've added some things to it. So after 2 weeks, right? Let's first go over a perfect scenario. Now, a perfect scenario, the way I define it, is if somehow after you shorted whatever stock you plan on being delta neutral on, that after you shorted it, it decides the price just gets frozen. It doesn't go up, it doesn't go down, it stays exactly where it is on the day that you shorted it. Because as I discussed in my previous video, because of the 2-week waiting period, if you short a stock and if the stock trades up, then you will have to spend more money turning the trade into a delta neutral trade in the liquidity pool, right? So in a perfect scenario, and these are the numbers, these are the actual numbers. So we did short ARK at 124.09 a share. And let's imagine that it's still at the same price. Now, where do I get this number from, right? So you might have done this, and now you're currently looking at this and you're asking yourself, well, what did I actually short it at? The easiest way to figure that out is you whip out your calculator, you head down to this section here, and you have these two amounts here. Take 1352 and simply divide it by 1089, And in doing so, you will receive the number. In our case, since we are looking at ARK here, you would receive 124.09. And that makes sense, right? Because when we're borrowing and instantly selling it, we are borrowing the actual shares. And in that exact moment, we're also being locked, the USD that gets locked up would be the USD for that whole trade, which would be 1352. And if you divide it 2, you'd get 124.09. Oops, I might have moved up a slide here. Okay. So in total, if we take the amount of shares, well, as you can see, 1352 is the amount that is currently available for us to withdraw. And we are going to withdraw it, and we have to add another 1352 in USD. And that makes perfect sense, right? Because for a liquidity pool, both sides have to be of equal value. So not only do we have to provide the same amount of shares on the long side if we want to have a delta neutral approach here, while for the liquidity pool, if we do want to earn an APR, we do have to also provide the 1352 in USD. Now, if you decide not to do this, it is still possible to be delta neutral. You can simply come over to the trade tab and hit on your stock and hit buy, and you could just hold on to your shares on the long side, and that is it. And you do not have to provide the other side of the USD. But in doing so, you will not earn any yield if you simply buy the stock. If you want to earn an yield, you have to contribute into the liquidity pool, the same way I have done so on Netflix or Silver or Tesla. And for that, you have to provide the other side of the trade also, which would be the USD. You can kind of see here, right? So I have 11, almost 12 shares of Silver, and I also have 253 USD to go along with it. Total value is 507. And you can kind of see how balanced that is, right? Because I have the value of the whole liquidity pool is 507. And 253 of that is in UST. And if you would multiply 253 by 2, because we have the assumption that this side would be right about the same as the other side, well, 253 times 2 would be 306, right? Yeah, we are disregarding 94 cents, but that's an extra $2 there. So 306 plus $2 is about 308, which just about matches up here, right? Especially because we did boosted up by 6 cents, obviously, in our calculation. So it literally fits it 1-to-1. So yeah, we get the 1352 from the short position. We use that with the additional 1352 that we have in our wallet, and we combine that for the liquidity pool. Now, for Twitter, we did the same exact math, 66.06 a share on the day that we shorted it. And if it stays at the same price, we need to use the 1333 we receive from the short position, right? It's locked up. And we have to, oops, I see what I'm doing here. I'm actually using a different slide here sometimes. That's why I'm actually confusing myself. That makes a lot more sense. There we go. So, and it's also larger. So, yeah, so we have to add 1333 in USD. We have in our wallet. In total, we will have to add 2685 USD to complete the liquidity pool. Just about matches up the number from our last video when we discussed how much USD to leave in your wallet. Now let's go forward. Let's go and see what actually happened, because obviously the stock prices did not freeze in time. I mean, it's been more than a month since I shorted these stocks. So what happened? Did I benefit during this time period, or did I actually screw myself over? And if we go forward here, again, we shorted at 124.09 a share, but ARK is actually trading at 119.59 a share at the moment. So ARK has actually gone down since we shorted it, which actually also means that our short position has a few bucks in profit. So to actually delta hedge our short side, we only need to provide 1303 to complete the liquidity pool instead of the expected 1352. And why is that? Well, we're still going to be receiving the 1352. When we claim that, that's going straight into our wallet. But we then have to take these amount of shares, right? 10.898. We have to buy them. We're going to take that, we're going to put it into the liquidity pool. Well, these amount of shares no longer will cost us $13.52 because ARK has gone down. These shares, that amount of shares, would actually cost us $13.03. And not only do we have to, actually, I believe I made a mistake here down here, but we'll get to that in a moment. So not only are we saving on the fact that we have to spend less money on the short side to have a delta neutral position, we also have to put in that much less money, which would be the same difference, right? So we could just whip out a quick calculator here and take a look at this. If we do 1352 minus 1303, so a $49 difference, right? But that's going to be times 2 because that also means we have to provide $49 less of cash on the other side, right? Because we have to provide the shares and an equal value in UST. While the shares are going to cost us $49 less, and the cash is, we need $49 less in cash, so that means $98 less we'll need to be delta neutral in this strategy here. Yes, $98. And actually, let's just head back. On the same note, we shorted Twitter at 66.06 a share, but it's now at 66.74. In this case, we actually have to spend more money to be delta neutral, because the money that we received, which is $13.33, it's not enough. We need $13.47 to be delta neutral. So we could run the same exact math here, find out the difference. Subtract it like that. It's a $14 difference times 2, $28. So we need to spend an extra $28 when it comes to Twitter to be delta neutral. Now ignore the amount at the bottom because I just noticed while talking to you guys, I completely forgot that we also have to use a different number for the amount of USD that we have to provide. So the number I used here was strictly just for the difference in the shares. So we'll have to just ignore that for the time being. But overall, if we look at this number 98, right? So we had 98 minus 28. So we have to use 70 USD less than expected, simply due to how the stock prices have moved over the last month and a few weeks. So that's not bad. It's not a tremendous movement. I guess there could have been instances where it would have been a greater amount, but at least we're not punishing ourselves, right, for this trade, and we're looking good. So let's get into it. You can see my USD here, which is 26.87 that I have in my wallet, which should be enough. And I'm going to show you exactly what you have to do from this point on to make sure that your trades turn out to be delta neutral as well. So the unlocked USD that we have available is 26.86. And then we have 26.87 in our wallet. So let's click on claim USD. Hit claim here. I will have to enter my password, submit it. Just give it a few seconds. Okay, perfect. So that UST is now in our wallet. We are at 53.71. Okay, perfect. So let's head on down and let's see how much ARK we have shorted. And we are going to grab, let me see how many digits. Oh, I think that's fine, right? We're just going to highlight that. I'm going to head over to trade. We are going to search for ARK, and there it is. Let's paste this here. This is currently the expected price of ARK. The fee that we will have to pay, which is about $1.72. We're using 1307 UST, which just about matches. We do when I made this PowerPoint a few hours ago, obviously the prices are going to change. It is after market hours at the moment. The market closed about 2 hours ago, but since in mirror the technically the synthetic assets can actually trade 24 hours a day, the price is going to move around. So the math is slightly off. So instead of 1303, it is coming out to be what did I look at 1307. That's okay. And we are going to click on buy. Let's hit on submit. Okay, perfect. Spread the commission. I mean, the funny thing is, if anything, almost in crypto, there's always going to be losses you're going to be taking on fees and commissions and on spreads. It's pretty crazy. It's just one of those things where that's kind of why I love this strategy of mirror and anchor, where you just kind of set it up and the rewards come in, and you don't really have to tinker around too much. You don't have to mess with things because the more you do, the more fees you accumulate, and they're definitely going to take a dent in your profits. But so we have ARK here. Look, say under holdings, we are now holding ARK. We have 10.898 of ARK. So what do we want to do? We want to head over to farm. We're going to look for ARK once again. There's the long farm for ARK, and we're going to click on what's in our wallet. And we have to add 1303 UST to match up the value of ARK. Once again, we're paying another fee of $2 here. Again, relatively significant fees, which is why you just want to set it up and just not mess with it too much. And let's click on farm. I will submit the transaction one more time. Perfect. Now, if we click on my page, there we go. Where is it? Right about here. So here is our liquidity pool for ARK now. So our liquidity pool is filled with 10.88 shares of ARK, as well as 1303 UST, for a total value of 2604. And again, the easiest way to check, let's just look and see how many shares short we are of ARK. It's 10.898, and we are long 10.88. We're a bit less, right? It's not perfect, and that's likely just simply because of the spread and the commissions and all that junk. And remember, as I said, these liquidity pools, from this point on, they're likely not going to stay equal. It's going to fluctuate. That's just the nature of liquidity pools, that if ARK goes up in value, what's going to happen is that some of your shares of ARK will automatically be sold in the background, and instead that value of ARK that was sold will be added to UST to help balance out the two, because both sides need to be at 50-50 at all times. But that's still good enough for our strategy, especially for the returns, because right now, at least in this very moment, on the short side, we are being paid 22%. And on the long side, we're being paid 27%. And again, if ARK goes up, sure, our short side loses, but our shares in our liquidity pool go up, so everything counterbalances itself perfectly. Now let's do Twitter. Same exact steps. We're going to head over, just going to highlight this much. Let me just make sure I did copy that. And we're going to head over to trade. Click on Twitter. Let's paste this right down here. I'm going to pay that much. There's one thing I could have done, which is this right here. I'm not really sure how much it's really going to help, but it's just a way to kind of set up a tolerance of how much slippage there would be. Sometimes the transaction may fail, as they do say, but in doing so, you might be able to reduce the amount that you're losing in the spread. And let's click on submit. Okay. So we have our Twitter. We're gonna go directly to farm. And let's find Twitter. Click on long farm. Select all the Twitter in our wallet. This is the UST that we have to add to it. Now notice in this moment, we have 1409 UST left in our wallet, and we have to use 1341. So everything's perfect, right? The UST that we did leave in our wallet was adequate enough to complete the delta neutral strategy, and everything worked as it should have been. So again, we have to pay that fee. We should be able to, let's see. Okay, I guess not. I guess when it comes to just contributing into a liquidity pool, there's no like slippage and things like that. So let's click on farm and we'll submit this last transaction, hit submit. Okay, perfect. My page. And just give it a few seconds. Yep, there we go. Pops right in. Oops, pops, yep, right here. So here's our Twitter. Long farm, paying a 27% annual interest, and so about 20.166 and 20.188. So again, slightly less than it would be ideal, but it's close enough. I mean, we're talking to the 100 points, decimal points. And that's it. And now it's going to start earning rewards. In the next hour or two, I should start seeing, some rewards appearing over here, which would be great. One thing I do want to mention, because I didn't get a chance to touch on this in the previous video. So when you short a stock, so let's head over to Google. Yeah, let's do Google, for example. When you decide to open up this whole process, right, do this whole strategy, and you decide to short, you're going to be shorting at the Oracle price, right, 28.18. If in that exact moment you have all the UST available to also set up a long liquidity pool, let's say you go to the long farm and you buy Google, you will not be buying Google at 28.18. You will actually be buying Google at 28.73 at the Terra price. Remember, there's a difference here. The Oracle price is the real world price of that asset, what it's being traded on an actual stock exchange. But the price up here, this is the Terra price. This is what it's being traded within the Terra ecosystem of blockchain. So you buy here, but you short here. Okay? So if you were to do this whole strategy and not wait 2 weeks or anything, you had all the money available and you decide to set it up, you will have to instantly spend more money on the long side to be delta neutral, because you shorted it, and the UST that you received UST valuing each share at 28.18, not at 28.73. And the reason I mentioned this is ARK actually benefited me much more than what the math turned out to be. And Twitter also benefited me more so than the math came out to be. But since we shorted at the Oracle price, and since the Terra price almost always trades at a premium, which is why there's an incentive to go short, you have this gray area in between where you actually need the stock price to go down a bit, about 2 to 3% over that 2-week period, for you to be able to set up a delta neutral strategy without having to add additional money to the long side than you initially expected. So that is something to keep in mind, because some of you might be looking at this and asking yourself, well, it doesn't make any sense. I shorted Google Google's traded sideways or traded down, but somehow I have to come up with more money to go on the long side. Well, that's why, that little discrepancy. And one last thing I want to mention about this too. When you decide to exit out of your position, so there might be one day when you tell yourself, you know what, Mirror is no longer worth it. I want to withdraw all my money. I want to get back my AUSD that's been appreciating and all that. There's a relatively big fee for that, believe it or not. So if we go over, let me just make sure I can do this. Click on Manage, for example. Click on Close. Take a look at what it would take for me to close the short position in ARK right now. 17.22 AUST. Okay. Well, we can ask ourselves how much is AUST worth right now, right? I mean, let's go over to the dashboard for Anchor and let's take a look here. Right now, one AUST is about 1.1 USD, right? So about 10% more. So just, if we take this 10% more, it'll be about $0.7 more. So about $19. $19 it would take to close this ARK position. Now, don't quote me, but I believe the number is like somewhere between it's either 1 or 2%. That's the actual fee for closing the short trade. So again, this is also pushing towards the idea that you do not want to be jumping in and out of these farms. If you like what you're seeing, if you feel that you could at the very least be in these things for the next few months, 6 months, a year, it's completely worth it. These fees won't account for too much. But if you're going to hop into this for a week, 2 weeks and hop out, these fees are definitely going to eat away at all of your gains. As I speak, I mean, here are the current profits that I have available since my last withdrawal, which is at 27.52. So one other thing that I recommend that you do is you keep an Excel file to get an idea of where your money is and what it's earning. One of the downsides, I would say, to the crypto space is that the reporting itself is not that great, right? Like even within Mirror, like it's hard to even know, like, what is your short position doing? Like, are you even profitable on it? Like, you know that you're short the stock, but it doesn't even show you the profit on it, right? And that would be the case if you're long. If you just went in here, and you just bought QQQ and you held on to it, it wouldn't show you the P&L on that position if you're just speculating whether the price is going up or down or whatever. So you do have to keep your own little Excel file here, right? So this is how mine looks like. I have the total amount of Anchor, the amount of money that was deposited into Anchor, what the APY is, right? I simply have it broken down by what the annual interest would be and the daily interest. And then here's all my long farms, right? The amounts, again, these amounts, to take them, you simply head over, kill this tab, head over here. So long farms, all the numbers are right here. They're all going to fluctuate. Keep that in mind. So you may want to update them here or there from time to time. The Tesla one has been here for some time. So let's look at it. So it's at 5,100, right? And in the file, it's at 4,578. So notice how the value of my long farm in Tesla has actually gone up from 45, it's actually gone all the way up to 5,100. It's a $600 increase. What was that $500 increase? Whatever. Close enough, right, between the two. And why is that? Well, Tesla likely went up. And it doesn't take a genius to also kind of realize that, because look at my collateral ratio for Tesla. Notice how it's the only one that's actually in the yellow, right? It's coming damn close to hitting that minimum 150% mark. And you definitely do not want any of your short positions to hit that mark, because then you get automatically liquidated, which is probably the worst thing that can happen, because the liquidations are not centralized in the sense that it's not going to be mirror that liquidates you out of your position. They actually have like liquidations contracts on the chain, and basically other people can see if they are able to liquidate you, because the contract says 150% ratio, you should be liquidated. Well, they're going to do it for mirror, and in doing so, they actually take a fee. They take a fee anywhere from 5 to 15%, and you're responsible for that fee, and you're kicked out of the position. So that needs to be managed, and I will likely save this for a different video where I'm going to come in and show you what you can do to manage this position, right? Because we want to pump these numbers up. 174 is too low. We do want to get it back to the 190s percentile. And how do we do that? Well, we obviously are going to come in and likely take some profits from our liquidity pool, right? We have an additional $500 here that we've earned. So we're going to take that $500 and we're going to start pushing it into these two positions. Because I did short Tesla on 2 different occasions, which is why it comes up as 2 different transactions here. So we'll have to put $500, maybe divide it between the 2 or something. We can see that one is actually double the size. Yeah, about double the size of the other one. So we'll have to split it up at some sort of ratio, but we do have to get these numbers up. So stay tuned for that video if you are going to be interested in it. Maybe I'll do next couple of weeks. Well, truth be said, obviously, if the position gets pressured more so, even in the next week, I might have to expedite how quickly I make that video, right? But yeah, let's look at something that, even silver, look at silver here, 240, right? So this actually tells me 240% that silver must have really gone down since I shorted it. Since, when we typically short it, as you saw in my first tutorial, usually it's at 200%, right? That's kind of what we use, that if you have $2 deposited with Anchor, you're going to use $1 to short with, right? Which means that your collateral ratio is at 200%. You have $2, but you're only using one of those dollars. Just think about it that way, right? Well, it went up from 200% to 240%. That tells me that silver must have gone down considerably, right? Because our collateral has stayed the same, how much we're offering. So the only change would have been in price. And if we look at the liquidity pool for silver at 507, I expect this number to be lower than what I have in the Excel file, because again, in the liquidity pool, we're long. So if it goes down, the whole pool goes down. So 507, see, when I first put this in here, it was at 529. So it's down a bit. Anyhow, getting back to the point, make sure you have a little file here to kind of keep track. It's never going to be 100% exact, but it's going to give you a good idea. I have my total capital that I have basically invested into the whole Terra ecosystem here, which is $20,000. And based on how all of these numbers come out, on this $20,000, I am earning 37% annual interest, which is awesome. I mean, it's awesome. We can kind of say that the yields from Anchor are relatively safe, right? They continue to, this is kind of the dashboard here. The reserves are looking fine for now. There's $67 million in reserve. And if we go to my page, or am I not on the right? Okay, if we go to earn, right, there's that interest. Obviously, and we know this now, our UST is not shown here on Anchor that we have with it, simply because we're using it as collateral on Mirror. But it does not mean that we're not making money on it, because again, keep your little Excel file here. If we head over to Anchor, I have my dates as to when I deposited money into Anchor, the total amount, and what the current value is. That value does have to be manually updated by you. The last time I updated it, maybe it was yesterday, maybe the day before, it was at 14,620. So how do we figure that number out? If Anchor's not going to tell us, where do we see it? Well, luckily enough, Mirror does show it to us under the collateral field over here, right? Since we are using AUST as the collateral, they even make it nice enough that they actually convert it over to UST. So the number is 635 at the moment. I'm going to come over here. So it's gained about $15 since I last updated this. So I've earned $518 from Anchor during this time period, which is a total return. not an annualized return, nothing. It's just a total return overall of 3.67% on my money, which is pretty impressive considering the fact that when I made my first video in this, talking about the strategy, was August 13th. The date is right here, and we added $5,227, which is a pretty good chunk. It's actually 1/3 of the whole amount that sits here. So, like the $91 and the about $900 was added all the way in June, so that we had more time to earn more interest on those amounts. But those are very small considering the last three amounts, especially the last deposit. So again, keep a little Excel file for yourself to kind of keep track of how all that is going. So what have I been doing with the money that I've been earning from Mirror? Because when we go back to this investment tab, notice how for Anchor, this daily interest is $7.54. This is the amount that's kind of basically accruing over here, right? We can't really touch that. We can't do anything with it. It just sits there, which is nice. One day we can obviously redeem it and do what we want of it. Oops, I'm jumping in between a few tabs here, but what do I want to discuss? But these rewards, this is from Mirror, and these rewards appear right here, right? Total claimable rewards. So you could do whatever you want with them. Me personally, I am using the rewards to buy Luna. If you like the Terra ecosystem and you believe in the projects, the best thing you could do, the most bullish stance you can take is actually by buying Luna. And I have been doing just that every time I redeem those rewards. Whenever I do, I used to redeem them every Wednesday and every Sunday. Basically, you can kind of see what the amounts have been. I decided to slow it down a little bit. Notice there's a big gap, 12-day gap between the last time and the recent date that I did this. And I'm probably going to do that because it does seem a little unnecessary to do it twice a week. I figure once a week is more than enough because, again, you're going to be accumulating those fees. And right now, Terra is actually going into a big upgrade phase. I think it's coming out in the next month or two, and they actually jacked up the fees in the meantime. I think you're paying like double the fees, and you are going to pay fees for claiming all the rewards, right? And then if you want to convert your Mirror to something else, another coin, you're going to pay fees on that too. And then since I like to stake my Luna, I got to pay fees on those too. So those fees accumulate, especially right now when the fees are actually higher than what they're usually going to be. And in an effort to reduce how much those fees really run me, I decided to only redeem it once a week. Maybe it'll even be twice a week. We'll have to see. But you can kind of see since I began this, I mean, looking back, I really wish, I started a little earlier because, as I started making more money, right, from Mirror, right, those like $100 a week, let's say between $80 to $100 a week, I've been making for the last 2 months or so. I've been buying Luna at like $29, $28, $31, at $40. 41 was my last purchase. But look at the beginning. In the beginning, I was actually purchasing it for under $10 for like a whole month straight, which is crazy, like how much Luna I was able to get. Like, on July 18th, I was able to buy 4.6 Luna, right? And now, I'm basically 2 weeks of earnings got me 2.7 Luna this time around, even though I have so much more money invested now into the whole Mirror and Anchor protocol. And then my total quantity, my total value. So this total value is important because that's actually what I've collected from Mirror so far. Those are my total profits from Mirror, right? So you could take the 856 and you could take the 518, combine the two, and that is what I've earned from this whole strategy that we're discussing in this video. Now, fortunately enough, as I've been buying Luna, it has also appreciated. As you can see, my average price is at $17.54, even though the current price of Luna, well, it's not at 40, but I believe it's somewhere at 38 right now. Last I checked before this video. So instead of 856, actually, yeah, it's the total value of my Luna is $18.55, which is that's an extra $1,000 on top of everything, which is fantastic for the strategy. But that's kind of it. And If you have any questions, I mean, throw them into the comments. I do plan on talking about how to manage the short position in a future video. I also suggest staying subscribed because I do want to cover some topics as to what's the longevity when it comes to mirror. Can you rely on this? Is this something that will stick around till next year? What about the year after? Are the APYs that we see today, are they going to stay the way they are? Is there something that can influence them, right? What about Anchor, right? For now, Anchor seems foolproof. It seems like the easiest money you could ever make, 20%. You do nothing. You sit on your ass. Is there a future in Anchor? I do plan to cover those topics. And if you like Terra and you like these sort of videos and you like how I explain things, subscribe. Subscribe, just leave a comment, like. I mean, it's kind of the best way to kind of show me some, if I see feedback on these videos and I see that people enjoy these videos, I'm more likely just simply to make them. Because it does take time. It does take time to do the editing that's required, even though my videos obviously are not edited that well and they're not prepared perfectly well, but it still takes quite a lot of time to get it together. But either way, thank you for listening, and until next time.